Hey everyone, welcome to the Clever Girl Finance YouTube channel. This is Bola, and today we're going to be talking about the types of accounts you should have to make sure that your finances are well organized and to make sure that you're planning appropriately for the long term. So the first account you want to have is the no-brainer account. This is your checking account. Pretty much everyone has a checking account or a current account, and what you use this account for is to pay your bills, to get your paycheck if you have direct deposit, or to deposit your paycheck into the account when you get paid. And this is really your baseline account. This is the account that all your transactions are going to go through, and this is the account where you're going to track your day-to-day spending. So sometimes people have multiple checking accounts, and that's perfectly fine. Some people want to have a checking account just to pay their bills and then a separate checking account for their day-to-day transactions. You just want to make sure that however you set up your checking accounts, it works for you. Also, one thing to keep in mind is that if you are currently paying a monthly fee for your checking account, you want to do some research and find a free checking account. Most banks will offer you free checking if you have direct deposit coming in, and so it's definitely not worth paying a monthly fee for a checking account. And if you don't want to do direct deposit, typically credit unions will offer you free checking and free savings. So if you're paying a fee for checking right now, you definitely want to do some research to find out how you can eliminate that fee from your account. So the next type of account you want to have is a savings account, and you want to have more than one actually. So savings accounts. The first type of savings account you should be thinking about is an emergency fund, and this is basically the account you're going to use to cover any unplanned life circumstances. So let's say you have to buy an unplanned plane ticket to go see family, your car breaks down, you lose your job. Your emergency fund is what's going to keep you covered. And ideally, you want to save 3 to 6 months of your basic life essentials in there. So being able to pay for rent or your mortgage, pay for transportation, and pay for food. And if you don't already have an emergency fund in place, then start with $1,000. $1,000 is a good amount that can cover pretty much the most basic emergencies. So fixing your car, buying a plane ticket. And once you get to that $1,000, then make a plan to start to add on to it. But 3 to 6 months is ideally what you want to have in your emergency fund. The next type of savings accounts you want to look into are savings accounts for your financial goals. So things like buying a house, taking a vacation, or taking an annual or yearly vacation, buying a car, whatever your financial goals are that you have coming up in under 5 years, then you want to make sure you have savings accounts for them so you can designate your money specifically to that goal. So let's say you're trying to buy a house in the next 3 years or the next 2 years, then you can open up a savings account to start saving for that down payment amount that you're going to need in order to purchase your house. Or if you like to take annual vacations or you want to take vacations with your family every year, then it's a great idea to open up a travel account where you start to put money into the account to pay for those yearly trips you're going to be doing. And again, when it comes to savings accounts, you want to make sure that you are setting up those savings accounts for money that you're going to need in less than 5 years. When it comes to money that you need in 5 years or more, so 5, 10, 15, 20 years, then you don't want to keep that money in a savings account because of inflation. So the typical interest rates on savings accounts are really, really low. And on average in the United States, inflation is about 2.5%. So over time, inflation is actually going to eat away at the value of your money. And so if you need your money in less than 5 years, then keep it in a savings account towards your different goals, and you can have multiple savings accounts. However, if you don't need that money for more than 5 years, so you're not going to need it until 10 years or 15 years, for instance, savings for retirement or savings for kids' college education or stuff like that, then you want to start thinking about investing that money. Which leads me into the next account type that you need. And you definitely want to make sure that you are saving for retirement, either on your own or through your employer if your employer offers a retirement plan, or by doing a combination of both. And you can do some research and talk to local brokerages or talk to your HR department to find out what your options are when it comes to saving for retirement. But it's really, really important that you start saving for retirement early so that you can take advantage of the power of compounding, and so that you have enough time for your money to grow for your future self. So when you think about that dream life you have of living out your retirement and not having to worry about money and being able to travel, you want to start saving for it, because when you get to that retirement age, that's what that money is going to help you do. It's going to help you avoid having to work 40, 50 hours of older age. It's going to allow you to live out that life of your dreams. However, you need to start saving early. So you definitely need to have retirement savings accounts in place. Also, another account type you want to think about are your non-retirement accounts. So these are accounts that are not tied to any penalties if you were to take the money out early. This is money that has already been taxed that you can invest on your own, and that would be called non-retirement savings. And again, you can do research to talk with a couple brokerage firms to find out what they offer. And one of the key things you want to keep in mind when it comes to looking at non-retirement and even your retirement accounts is what the expenses are. You want to be careful how much you're paying every year, because those annual fees, they do add up. And you also want to find out about their customer service, because that really matters when you are keeping money with a brokerage firm or with a company for a long amount of time. Also, it's really important that when it comes to investing, you do your research. So your retirement investing, your non-retirement investing, you want to make sure that you understand where your money is. You have a good idea of what your money is doing. Even if you may not be an investing guru, it's a good idea to understand the basic concepts. So buy an investing 101 book and start to learn about how investing works. Ask questions. If your company offers a retirement plan, ask your HR department questions. Ask the brokerage company that hosts your retirement plan questions. And if you are investing outside of your retirement plan, outside of your employer's retirement plan, ask questions to the brokerage company and try to understand as much as possible. And you want to be very wary of high fee accounts when it comes to your retirement investing accounts and when it comes to your non-retirement investing accounts, because over time those fees can eat away at your growth. And when it comes to investing, it's really important to take advantage of time. So start as early as possible. Time allows your money that's invested to weather any storm. So, if there is a market decline, you need time for the markets to recover. And also, over time is how your money is going to grow and realize the impacts or the effects of compounding interest. So you definitely want to start saving as early as you can. And it's never too late to start, but don't delay saving and don't delay investing until you start earning more or until you get a better job. If you have debt and your employer also offers a employer-sponsored retirement investing account or retirement savings account, and they're giving you free money, I recommend that you contribute enough to get the free money from your employer and then focus on getting rid of your high interest debt. And then once that debt is gone, you can put more money towards your retirement investing and also start thinking about non-retirement investing. Okay, finally, the other type of account you want to think about having is saving for your children. So if you have small children, it's a good idea to, if you can, start saving for college or even save for their future grade school or high school expenses. So field trips, instruments, clothing, summer vacations and things like that. It's a good idea to make sure that you are prepared to be able to manage your child's expenses. That way you don't have to dip into your own savings and you don't have to leverage debt in order to cover their expenses. So those are the key accounts you want to think about having: checking account, your savings accounts, specifically emergency savings accounts, and then other savings accounts for your financial goals that you want to accomplish in less than 5 years. You also want to focus on saving for retirement and think about non-retirement investing, because non-retirement investing gives you an opportunity to save even more money. And then finally, saving for your children. So I hope this has been helpful, and I'd love for you to subscribe to this channel if you are enjoying the content I'm sharing. And also head over to clevergirlfinance.com and hit subscribe there. I'll talk to you guys in my next video. Bye.